Hello everyone, I'm Mr. $I Investor, and on this channel, I provide practical financial education for smart investors worldwide. Today, we're discussing a critical decision that could impact your portfolio's future for decades. You want to diversify your investments, but you're faced with two powerful options: ETFs and index funds. Social media is full of conflicting advice. ETFs are better. No, choose index funds. But what's the real truth? I'll give you an objective analysis backed by 15 years of industry experience, real data, and mathematics. By the end of this video, I promise you'll know exactly which investment vehicle suits your specific situation. Plus, I'll share a custom decision-making matrix that you can use immediately. Let's dive in. Asterisk, let's start by truly understanding these concepts, because 80% of the internet has incomplete or misleading information. What is an ETF? Exchange-traded fund? Think of it as a basket containing dozens or hundreds of different stocks, bonds, or commodities. You can buy and sell this basket on the stock exchange just like individual stocks. An index fund is a traditional mutual fund structure that passively tracks a specific index. Here's the critical point that's often misunderstood. Both typically track the same index. For example, there's the Vanguard S&P 500 ETF, VU, and the Vanguard 500 Index Fund, VFIAX. Both track the S&P 500 index. The holdings inside are virtually identical. So why do we have two different vehicles? The difference lies in their operational mechanisms. You can buy VU at 10 a.m. for $420 and sell it at 2 p.m. for $425. But with VFIAX, you can only transact at the end of day price, regardless of when you place your order. Does this matter, you might ask? It matters tremendously.
Ow!
Because this difference completely changes your risk profile, cost structure, and investment strategy. Let me show you exactly how. Now let's dive deep into these operational differences, because this is where most confusion happens. ETFs use a creation-redemption mechanism. Large institutional investors called authorized participants create and destroy ETF shares. This process keeps the ETF's price close to the actual value of its underlying holdings. Example, if the SPDR, S&P 500 ETF SPY price deviates too much from the S&P 500 index value, an arbitrage opportunity emerges. Institutional investors immediately notice this and bring the price back to normal. Index funds are simpler. You invest money. The fund buys index stocks with that money. When you want out, the fund sells stocks and gives you cash. Why does this difference matter? Liquidity. ETFs have higher liquidity because there are always buyers and sellers on the exchange. Point 2. Price discovery. ETF prices change continuously based on market conditions. Index funds make you wait until end-of-day.3. Minimum investment. You can buy even one share of an ETF. Index funds often have minimums $1,000, $3,000. Here's fascinating. 2024 data. 73% of ETF investors never trade intraday. This is striking, and the flexibility exists, but most people don't use it. This leads to an important conclusion. Don't base your decisions solely on operational differences. Asterisk. Now we're getting to the most critical topic. Costs. The internet is full of confusing information about this. First, the visible costs. ETFs. Management fees. US average 0.03%, 0.75%. Vanguard S&P 500 ETF, VOO, 0.03%. iShares Russell 2000 ETF, IWM 0, 19% index funds. Management fees, 0.04% to 1.00%. Vanguard 500 Index Fund, VFIAX 0.04%. Fidelity Total Market Index, FXAIX 0.015%. So, ETFs are cheaper, you might think. But wait, there are hidden costs. ETF hidden costs. 1. Trading commissions. $0 to 7 per trade varies by broker. 2. Bid-ask spread. 0.01% to 0.15% typical. 3. Market impact, price movement on large trades index. Fund advantages. 1. Usually no trading commissions 2. Automatic investment plans are free 3. Dividend reinvestment is automatic, and free. Let's do a real calculation. $100,000. Invested over 10 years. Scenario 1 ETF monthly investing, management fee 0. 0.11% year. Scenario 2 index fund, management fee 0.04%. YEAR trading cost $0. Total cost 0.04% year. The difference about $700 over 10 years on a $100,000 investment. As you can see, if you trade frequently, ETFs can actually be more expensive. Asterisk tax efficiency is where ETFs truly shine, and this is often the deciding factor for many investors. General Tax Rules 2025. Both are subject to capital gains tax. When sold, dividends are taxed as either qualified or ordinary income tax advantaged accounts. 401k. IRA eliminate most tax differences, but here's where it gets interesting. ETFs. Extremely tax efficient due to in-kind redemptions when large. Investors redeem ETF shares. They receive actual stocks instead of cash. This process allows ETFs to purge low basis shares without triggering capital gains. Result: ETFs rarely distribute capital gains to shareholders. Index funds, less tax efficient. In taxable accounts, when investors redeem shares, the fund may need to sell holdings. These sales can trigger capital gains. Distributions to AL shareholders: you could owe taxes even in a year when the fund lost money. Example from 2023. Average U.S. equity ETF capital gains distribution 0. 1% of NAV. Average U.S. equity mutual fund capital gains distribution 1.2% of UNAV. That's a massive difference. Over 20 years, this tax efficiency can add tens of thousands of dollars to your returns. However, this only matters in taxable accounts. In tax-advantaged accounts like 401ks and IRAs, the difference disappears. Important note: tax situations vary greatly. Always consult a tax professional for personalized advice. Let's discuss critical factors. They rarely get mentioned, but can significantly impact your returns. Liquidity, risk. ETFs trade on exchanges, so theoretically very liquid, but some sector or international ETFs have low daily volume. Example, some emerging market ETFs trade less than $1 million daily in stress periods. You might face wider bid-ask spreads. Index funds. The fund company must redeem your shares. Liquidity issues are rare for shareholders, but in extreme market stress, funds can halt redemptions, though this is very rare. Tracking error. This is crucial but rarely discussed. Neither vehicle perfectly tracks its index. 2024 U.S. data. S&P 500 ETFs average tracking error 0.02%. S&P 500 index funds average tracking error 0.04%. ETFs generally track more precisely due to their arbitrage mechanisms. Securities lending, both. ETFs and index funds often lend out their holdings to short sellers for additional income. This can boost returns by 0.1% to 0.30% annually, but it introduces small counterparty risk. ETFs are generally more transparent about this practice. Counterparty risk. ETFs market maker risk exists, but is minimal. Index funds. Fund company risk exists, but is also minimal. Both are very low risk, but worth understanding. Asterisk theory ends here. Let's look at detailed real-world profiles. Profile 1. Young professional, 25 to 35 years. Mike, 29. Software engineer, annual income, $85,000. Monthly investment, $1,500. Risk tolerance. High-tech savvy, uses mobile apps actively. Occasionally wants to make tactical moves. ETF is better because low minimums. $100 plus per share intraday trading capability. Lower fees for his investment. Size. Profile 2. Middle-aged family, 3550 years. Sarah and John, 42, 2 kids. Household income, $120,000. Monthly investment, $2,000. Risk tolerance, moderate. Focused on retirement planning, wants simple. Automated solutions. Index fund is better because Automatic investment plans, less stress from price volatility. Focus on long-term accumulation. Profile 3, pre-retirement, 50+ years, Robert. 55, experienced investor. Portfolio, $800,000 new investments, $3,000 a month. Risk tolerance, the moderate tax optimization is critical, gives hybrid strategy, asterisk. Core holdings, index funds, automated asterisk, tactical positions, ETFs, tax efficiency profile for active trader. Lisa, 35, works in finance, investment amount, variable $20,000, $100,000. Risk tolerance, very high daily market monitoring, uses timing. Strategies, ETFs, definitely better intraday liquidity. Tax efficiency for frequent trading. Asterisk, better price discovery. Asterisk. Let me give you a detailed real-world data analysis. 2024 performance comparison, S&P 500 tracking 1. Vanguard S&P 500 ETF, VU, expense. Ratio, 0.03%. Tracking error, 0.02%. Annual return, 24.2%. Average daily volume, $8.50 billion. 2. Vanguard 500 Index Fund VFIAX. Expense ratio 0. 4% tracking error. 0.03% annual return. 24.1% minimum investment. $3,000, the difference is only 0.1%. But this small difference compounds significantly over time. $100,000 invested for 20 years, assuming 8% average annual return. ETF scenario, gross return, 8%, costs, 0. 3% net return, 7.97% after 20 years. $474, 349 index fund scenario, gross return, 8%, costs, 0.04%, net return, 7.96% after 20 years. $473,874 difference, $475. For a buy and hold investor, the difference is minimal, but this assumes you never trade the ETF. If you make frequent trades, commission costs can quickly erode this advantage. Tax impact, taxable account, over 20 years. The ETF's tax efficiency could save an additional $5,000, $15,000 in taxes for a high-income investor. Bottom line, for long-term passive investors, the choice matters less than you think. For tax-conscious investors, in high brackets, ETFs have a clear advantage. Now, I'll give you a custom decision-making system. Answer these questions and score yourself. 1. Investment frequency, 1 to 6 times per year. Index fund plus 2, ETF plus 1, 6 to 24 times per year. Both plus 1 minus 2 plus times per month. ETF plus 2, index fund minus 12. Account type, tax advantaged, 401k, IRA. Both plus 1, taxable account, ETF plus 2. Index fund plus 13. Technology usage, active mobile app user, ETF plus 1. Prefer traditional methods. Index fund plus 14. Investment amount under $1,000 monthly. Index fund plus 1. $1,000, $5,000 monthly. Both equal over $5,000 monthly. ETF plus 15. Risk tolerance, low. Index fund plus 2, moderate. Both plus 1 high. ETF plus 16. Tax bracket, minus 12% or lower. Both equal. 22 to 24%. ETF plus 1 to 32%. ETF plus 27. Automation preference. On automatic investing, index fund plus 2, don't mind manual. ETF plus 1, score your results. Higher ETF score, choose ETF's higher index fund score. Choose index funds tied. Split 50/50ths between both this. The system is based on academic research and really works in practice. Additional consideration, many investors successfully use both. There's no rule saying you must choose only one. Asterisk for sophisticated investors. Here are some advanced approaches. Strategy 1, core satellite model. Core, 80%. Low-cost index funds for stability. Satellite, 20%. ETFs for tactical moves. Tax efficiency strategy, 2. Tax location optimization. Tax-advantaged accounts. Either works. Choose lowest cost taxable accounts. Prioritize ETFs for tax. Efficiency strategy, 3. Dollar cost averaging plus regular investments. Index funds automatic. Lump sum investments. ETFs immediate deployment market dips. ETFs quick entry strategy. For rebalancing strategy, annual rebalancing. Use index funds. Tactical rebalancing. Use ETFs more precise. Tax efficient strategy, 5. Life cycle approach. Accumulation phase, 20s, 40s. ETFs for flexibility, pre-retirement, 50s. Hybrid approach, retirement. Index funds for simplicity. These strategies are for experienced investors. If you're starting out, keep it simple with one primary vehicle. The key insight: you don't have to choose just one forever. Your strategy can evolve as your situation changes. Asterisk, asterisk today. We've done a comprehensive analysis covering every aspect of ETFs versus index funds. Key takeaways. 1. Both track the same index's performance difference is minimal. 2. The real difference lies in your investment style and tax situation. 3. Costs matter. But they're not the only factor. 4. Tax efficiency can be a game changer for high earners. 5. Knowing your investor profile is most critical. Your action plan. 1. Apply the decision matrix we just covered. 2. Research 3 to 5 specific fund options. 3. Start with a small amount, $5,000, $10,000 to test for. Evaluate performance after 6 months. 5. Scale up with the winner in the video description. I've included a free Excel calculator and fund comparison spreadsheet. Download them now. If this video was helpful, smash that like button. Share your investor profile in the comments. Subscribe for weekly market analysis. Personally respond to comments with specific recommendations. Just tell me your age, monthly, investment amount, and risk tolerance. Remember, the best investment strategy is the one you can stick with consistently. Don't let perfect be the enemy of good. Next week, I'm covering the 10 best ETFs for 2025 to 2026. You won't want to miss it. Thanks for watching, and here's to your financial success.